Hello everybody, so welcome to round 2 of the Q&A. These questions were submitted on my Patreon by my Patreon member, and I thank you so much for these questions and giving me ideas for these videos and for this channel. So let's get started. Do I care about top management team quality? This is something you may have noticed. A lot of the YouTubers, they talk about top management team and they praise management team. Even sometimes, this annoys me by the way, but even sometimes you listen to podcasts and you'll have a podcaster who's going on and asking the CEO about where they grew up and their high school days, and they waste 20 minutes instead of getting into the meat of the podcast. That annoys me. Like recently, I think a Harvard podcast or something like that, I did that with Sam Altman. Even Sam Altman was focused on, why are you asking me about high school? Ask me about AI. This is kind of my feel. It's like, yeah, the founders, the manager, yes, that's great. They're a celebrity, sure, that's great. But at the end of the day, I care about the business. I care about the company. Think about politics. This is the way I think about the United States politics, for example. The US is a great country, no matter who the president is. The institutions are there. The land is there. There's so many wonderful stuff going on, and it's just not one leader is going to kill the country in 4 years, or not one leader is going to make the country the best in 4 years. I think this is mostly like that for companies, unless you are in the early days. If you're in the early days, yes, the founder of the business matters. It matters that it's a founder-led business, but even that is a misnomer. Most people care about founder-led businesses because they think the founder is the biggest owner of a business. In my case, I care more. I'm going to make this up. I care more of a largest owner-led business. A largest owner-led business. For example, Musk may not be the founder of Tesla, but he is the largest owner of Tesla. And as a consequence, I think in his case, in his situation, leadership really matters because he has an incentive to not screw up the stock price of Tesla and get a call on X or whatever, something like that. That matters a lot in that situation. I want the net worth, most of the wealth of the leader of a business to be tied within the business. But this is more of an agency question than really it is a leadership question, right? This is more agency theory type stuff. So I want the leader of the organization to be a good agent for the shareholder, and that's only going to happen if the leader of the organization is also the largest owner of the business. That's what I care about the most. Now, we can talk forever about managers' experience and all of that sort of stuff. In my view, I'm more of a believer that it's the great business that makes the great manager. And if you put a great manager at the helm of a bad business, I don't think there's anything they can do. I mean, it's very tough. If you put a great manager at the head of a bad business, typically a great manager is not going to accept an appointment at a bad business, anyways. And I've listened to so many conference calls who tell you that CEOs are generally smart. Once in a while, you'll have one who stands out as really dumb, and then not to invest in company. But they're generally sharp people. This is my experience, at least for the stocks that I follow on the channel that I invest in. They are very smart people. Again, a good manager that's been dealt with a wrong set of cards that not much you can do. And I'll make this point, and I'm just gonna pick on Steve Ballmer. I really shouldn't. He was a great investor because he kept all of his stock in Microsoft instead of selling it like Bill Gates. But I'm not calling him an awful leader, but even leaders that don't seem like good leaders on the surface, they can't kill strong businesses. And Ballmer missed so much at Microsoft. So many opportunities were missed. But because Microsoft was the leader of the personal computer, and because the personal computer is still very prominent, the business of Microsoft ended up being fine and being one of the leading businesses of today, despite having had nearly a decade of Steve Ballmer at the helm. And I suggest you look this, Steve Ballmer going crazy on stage, and then you make your own opinion of a leader. He did not kill Microsoft. I think we spend too much time as investors analyzing the personality and all of the lovey-dovey stuff of the leader. and really not enough time analyzing the business. And it is the business that matters. I personally don't get into, all of these leadership books, all of these. Anyways, it's fluff. There's so much fluff when you start discussing leadership. It's not as tangible as actually analyzing the business, the structure, the industry, the product, the marketing. This is what matters a lot to me. Moving on to Snowflake, and I put Databricks and Palantir. I don't have much to say about Databricks because it's a private company. The only point is, so the question was about Snowflake. And of course, if I talk about Snowflake, I have to talk about Databricks and Palantir. These businesses operate in the world of data apps, or in the world of you codify all of the data in the business. In the case of Snowflake, you put it on a database operated by Snowflake. And once all of your data connects to a database, then you operate the business with an app built on that data. All of these free companies aim to do that, or at least that is the long-term grand vision these companies have. Palantir seems to be the winning player. Now, if you remember my very early days video about Snowflake, and I believe it was Snowflake's prime time, and I never got around to really looking at Snowflake. I sold Snowflake really quickly after I was disappointed by some of the fluff that was thrown by Slootman back in the day. Anyways, Palantir is my only position between. I don't own Snow anymore. I used to a long while back, but I don't own it anymore. I think the fact that there's a private competitor to Snowflake in Databricks, I think kind of misleads us, because we may think there's no competitor. No, there is a competitor. And then Palantir, they pretend to be in an entirely different dimension. My initial draw to Palantir was the military business, the government business, etc. Snowflake, let's briefly talk about Snowflake. So like I said, they are the data cloud. They take all of your data and they put your data in the cloud, and then you can access that data more easily. You break down the silos within the organization. You can build apps between the organizations. They are adding features, right? Like a weed, adding a bunch of new features every single year. And you can see in 25, they added a lot of features. And again, the product is very sticky, and a lot of people seem to really enjoy that product. That product also has a marketplace, which allows you to buy data from your partners, and you buy data from your suppliers, etc. When Slootman left the company, Snowflake lost a bunch of valuation. And I find that funny, because in my view, actually, Snowflake should have gone up when Slootman left the company, because he didn't seem to do a lot of good to this company, in my view. And it seems like the new CEO was dismissed for 6 months or something, and now it's just back up to roughly the day that the new CEO was announced. So Snowflake seems to be doing better than many thought. What I do not like about Snowflake is that the operating margin is essentially flat, if not zero. And of course, they communicate on adjusted free cash flow, but this is not the standard. Companies use adjusted EBITDA. Why aren't you telling me your adjusted EBITDA, Snowflake? Well, I'll tell you why. Because their adjusted EBITDA, which is my proxy for cash flow, is minus 39%. That's why they're not telling you about the adjusted EBITDA. They're focusing on the adjusted free cash flow. Free cash flow is too sensitive to one-time yearly event type stuff, and I wish this was a company who was more profitable. It's true that Palantir is actually making real cash right now, and it doesn't seem to be the case for Snowflake. Now, granted, Snowflake is much cheaper than Palantir, although it's easy to be much cheaper than Palantir. Palantir is a nosebleed valuation. It's tough, if not impossible, to understand why Palantir is so expensive. I would never buy Palantir at this level, but I would not buy Snowflake at this level either, because it's still trading nearly 13 times forward revenue. That is quite expensive in my view. And so, anyways, that's my take on Snowflake. These companies are expensive. SaaS is expensive. Now let's talk about SaaS and Gitlab. So this was a question about Gitlab and then about SaaS in general. So let's talk about Gitlab. I had covered Gitlab a while back. I was very lucky with my timing when I covered Gitlab, because as soon as I covered it, the stock went way up, and then it was not a good deal anymore. over my metric, the enterprise value over gross profit or revenue growth, actually for the SaaS sector, it's not that bad. But the problem with GitLab is, just like many SaaS companies, they have negative EBITDA margins. So in my view, this company is pricey, given that they are losing some money right now. And this is where I'm gonna. So I'm sure it's a great business. I mean, GitLab, it's the software for software developers. If you remember this whole thing, they claim to be much better than GitHub. GitHub is the property of Microsoft. They claim to be much different than GitHub. They're a interesting company, fully decentralized company. People work from around the world for this company. They've built their own niche following. Feel free to look at my video from 2 years ago where I covered it. It's a great business, but the numbers don't yell at me a buy when I look at this company, at least my spreadsheet. And of course, I have a limited amount of time that I can spend on studying each company. I'm not going to spend a lot of time looking for red flags if the numbers don't tell me that it looks like a good deal in the first place. My thoughts on software as a service in general, or SaaS. SaaS has been the darling of Wall Street for the past, what should we call it, 10 years now? So good. But in my view, there is a big double threat from AI. And this is something that a few people have begun to highlight, not just me. So what is that big double threat? First of all, is how many elite users actually use these apps? You see, all of these AI apps, they add more and more features and more products. Yeah, and we have to wonder ourselves, how many of these features and products are really wanted by users? The power users, the elite users, will always want the best product out there. But for most companies, there is a strong case to make that you could have 80% of the features of current apps for only 20% of the effort or 20% of the work. So the 80-20 rule here would suggest that today a small IT team with amazing AIs can develop tools that mimic the GitLabs of the world and mimic a lot of these SaaS companies of the world, and they can do it for a much less costly thing. And so if most of the users of these SaaS companies are not elite, if they're not elite, if they're just there and it's just the software company trying just push features on you, and they keep pushing features on you just because they have 2 full-time employees who have to justify their salaries, then it's a threat. It's a threat. I could see a lot of people canceling their SaaS services and just say, okay, we're gonna develop something in-house, and then every company becomes like a Tesla or a Google, where it's only operating in-house software. Another risk, of course, of AI is the replacement of employees by AI agents. If AI agents replace employees, watch my video on ServiceNow, by the way. That's the whole thesis behind ServiceNow. If that were to happen, then all of these seat-based SaaS companies that operate based on the number of laptops or the number of seats in the company, they could be at risk. And so they need to change their business model and start charging based on usage as opposed to charging based on the number of users. And so that is why, Snow has a usage-based pricing. So that's one of the reasons why, for example, as a SaaS, I would prefer Snow. But in the case of CrowdStrike, so CrowdStrike has a seat-based pricing, but it has a network effect moat, and Snowflake also has a marketplace which gives it a network effect. These two companies have network effect type moats, which means that you're less likely to be disrupted by AI if your main reason to sign up for that company is that there is a network effect that protects you. A network effect that protects you from the competition, and these network effects make these companies winner take most companies. So if a company relies on network effects for its advantage, if a SaaS company relies on network effects for its advantage, I don't think you're as threatened by AI. But if you rely on mostly seat-based pricing, or if a lot of your users are not elite users or power users, I think there could be a real threat from AI to a lot of these companies that have popped up everywhere over the past 10 years. Let's talk about tariffs and Gigacloud. So Gigacloud is a drop shipper. Should I call it a drop shipper? It's pretty much a company that connects manufacturers to sellers of furniture, but they've entered over goods to sellers. So what you do is you have a local store in your local town, a local showroom. Well, if you order something from them, they get on their Gigacloud website and they order straight the couch from China, and the couch will go straight from China to your front door without ever touching the shop, or without ever touching the Amazon seller, or without even touching, the Shopify website that you came across on Instagram who happened to be selling this Chinese furniture. And so because of that, it allows an end-to-end shipping of the furniture from Asia, from China, to somewhere in the USA, to somewhere in Europe, with the end consumer not realizing that the work is actually done by the third party, the work is not done by the local shop or the website that you bought it from. In my view, this company still qualifies as a super gem, and that is because I don't consider it a China company, but a lot of people consider it a China company with just a US shell, and if you do that, well, you may want to eliminate it. I know a lot of people are wary about investing in Chinese companies. Some good news about Gigacloud. They've announced a $46 million share buyback. That's let's call it 5% of the market cap. So that should have a positive effect on the pressure. And the question of my Patreon supporter here is about tariffs and how are tariffs going to hurt a company like Gigacloud. Well, first of all, the analyst asked no question about tariff on the call, and I'm going to be cynical here and say, oh, it's normal because analysts don't worry about threats that are 12 months out, and tariffs, it's a 9-month out or 12-month out thing, so we're not going to worry about that because these things take a while to be implemented, and even if they implement a tariff in 25, you may see the first tariff of on January 1, 26. So analysts don't care because it's more than 12 months out. It's not in the model, so they're not going to care. But my viewers and my supporters care about tariffs. I think that's a fair question. That's a good question. Even if the tariff is 60%, which is what a lot of people are saying, it could be worst case scenario for a lot of the Chinese goods. Even if that is 60%, there's two things I want to say. One of them is these tariffs can be absorbed by manufacturer rebates. Manufacturers will give you rebate to keep selling. They'll eat some of that tariff. Secondly, you could have things happen to the currency, right? You may have a tariff imposed on all China good, and then the Chinese decide to depeg the currency relative to the dollar, and so a change in the exchange rate may take care of some of that tariff. And then lastly, a third of that tariff increase may in fact end up in the pockets of the customer and or in the form of lower profit for the dropshipper or for the local store. So I'm not saying that there's not going to be a cost to the tariffs, but I'm saying that multiple people are going to be eating that cost of the tariffs. It's not going to be just the consumer, or it's not just going to be the manufacturer. It's going to be spread out among multiple people. And so it's going to be tough to justify where the extra cost, who eats the extra cost of the tariff. But the delta between the price of US-made furniture, no tariff, compared to the delta of Chinese-made furniture is going to be so vast still with the tariff. Even if you assume there's a 60% tariff and you say currency changes take care of 20%. You say manufacturer rebates take care of 20%. And you say, oh, I don't want to give up on the margin, so the end customer takes care of 20%. Look at the price of Chinese furniture, right? So if this is 20% more expensive, right? That's $535 for a full couch sofa set, right? From this Chinese supplier. This whole set it's a big couch. It's $535. So okay, so even in a scenario where the tariffs, let's assume the worst case, let's assume this is $600. Well, guess what? Lazy Boy couches, they're still $5,000 if you don't want leather, right? If you want something like that, Lazy Boy in leather, you're going to be at $7,000 or $8,000. And Lazy Boy, by the way, which is the most American-made brand of furniture that I can think of, that's famous, right? So even if you take into account them, don't forget that they're going to have a tariff too, because I just looked up their supply chain. They have a bunch of their furniture made in Mexico. Mexico is going to get a tariff too. by the way. It's not that straightforward. Products win when they're an order of magnitude better, and that would be the case, right? $500 couch versus a $5,000 couch. You're one order of magnitude better, and by better here I mean cheaper, right? You're one order of magnitude better. That order of magnitude is not going to change. Like you're going to get a 0.9 order of magnitude better, so you're going to be 9 times better. Like it's not going to change, and I suggest, and of course, this is the type of platform. This is a random drop shipping platform I took here. This is the type of drop shipping platform that Gigacloud operates, right? I didn't register, so I can't see the prices, but I know the prices are cheap on this stuff. People have no idea how cheap these things are. There's a reason why there's furniture store everywhere, because it's so cheap. Look at this, a sofa bed, $56. I don't know what luxury, comfort, exceptional quality mean. I don't know what that means, but this is between $125 and $299. It looks really good, doesn't it? So again, if Chinese furniture is gonna remain an order of magnitude cheaper, if Chinese anything is gonna remain an order of magnitude cheaper, I don't think the tariffs are gonna have a major impact. And let me finish this video with the last question about Canada. So, Canada. Are there opportunities in Canada? My Patreon subscriber asks. Why wouldn't we look for good deals in Canada? And in a nutshell, the answer to that question is yes. Yes, there are. So as soon as I saw this question, I thought of 2 companies that are in the spreadsheet. So Shopify, of course, the most praised Canadian company in my world. That's perhaps the most American Canadian company, Shopify. And so super successful, no doubt about that. Shopify, unfortunately, is expensive. How much am I paying for that growth? 1.47. You can see, you if you look at Mercado Libre, for example, you can really see the Canada premium compared to, say, a Mercado Libre, which is at a 0.29, right? Mercado Libre, it's trading at 4 times forward revenue, right? Even C Limited is roughly 4 times forward revenue. Shopify is 14 times forward revenue. So you can see that premium on the stock. And another company, which this one is cheap, it's Welltower Health. That's the ticker symbol in the US. I think in Canada it's well.to is the ticker symbol. I find it cheap on a lot of my metrics here. I haven't pulled the trigger because I'm already so heavy in the direct-to-consumer healthcare disruption that I haven't pulled the trigger. But they have a major business in Canada, and they seem to be cheap, although in a similar sector, you can see that once again, the American players are cheaper. In the case of LifeMD or Hims, between 2 and 4 times cheaper. The business is slightly different, granted, but nonetheless, cheaper. And I'll conclude, and I feel bad saying there's also a premium on these two. In crypto, there's a lot of very interesting over-the-counter OTC stocks in crypto in Canada. This one is Sol Strategies, so they're essentially copying the Michael Saylor's playbook, but with Solana. But I just calculated that premium. It's what is it? More than 180 million dollar Canadian, and they only have $40 million worth of Sol. So you're paying like 4 times or 5 times the Sol here. And same for Federal Bitcoin. This is a Bitcoin miner was adopted the playbook, was adopted the MicroStrategy playbook, 18 million. Again, that's a micro cap, super risky stuff, super micro cap. But they only have 5 million worth of Bitcoin, or 4.6 million, I believe, worth of Bitcoin. So you're paying 4 times the price of Bitcoin for it being wrapped in a micro cap. So these two, even though they are innovative, and these are innovative strategy, there is still a high premium on these two. So the moral of the story is Canada is expensive. It seems like a lot of the Canadian stocks, at least those that I haven't covered on as part of this channel, they are expensive. And so I wonder sometimes if that has to do with the fact that a lot of Canadian pensions or Canadian institutions, maybe investors in Canada, they, depending on tax planning over there and stuff like that, maybe there's some preferential access to Canadian stocks, which bids up Canadian companies. It's like if you have a tax-deferred account, are you allowed to buy US stock in a tax-deferred account in Canada? These are all stuff, unfortunately, that I know too little about, but because I haven't looked at it. But if I look at Canadian stocks and I find these stocks very expensive, I tell myself maybe there's a reason behind that, which is that maybe some institutions have to buy Canadian stocks, and as a result of that, they become more expensive. So, in a nutshell, the answer to that story is yes, there are opportunities. As far as expensive, world-leading high growth, you have Shopify. As far as cheap, good growth company, you have Welltower. Their Bitcoin and crypto proxies in Canada are expensive at this point. I find them expensive. So hopefully that answers your question, and thank you so much for the question. So let me conclude by saying that this was not financial advice, not investment advice, just entertainment. As always, always entertainment. Please like, please subscribe. Thank you so much for watching, and have a wonderful, wonderful day.